Good afternoon and welcome to this webinar with Castings Plc, hosted by Yellowstone Advisory. We're delighted to have with us both Adam Vicary, the CEO of Castings, and Steve Mant, the FD.
Good afternoon, everybody. It's a presentation of Castings Plc. Some of you who obviously are shareholders know a bit about us, and some of you don't. I'm going to give a bit of an outline about the business. Steve will add a bit more detail on the financials, and hopefully you find it interesting. So this is our company. We are 3 operating sites: Castings Brownhills, which is where I'm based at; William Lee in Dromfield, which is sort of north of Chesterfield, south of Sheffield; and our machine shop, which is also here in Brownhills. As you see, the business started as a typical Black Country business based in Warsaw in 1835, and moved here around about the end of the 1950s. Total employees currently about 1,100, and turnover, well, last year obviously was impacted, but typically 110 to 160 million. And that's probably where we're headed to this year. So in terms of as a timeline, I already said that the business came here to Brownhills in the late 50s. As a lot of Birmingham-based businesses, it was floated on the old Birmingham stock market. The old Warsaw site was closed. The William Lee facility was acquired. Perhaps one of the most important parts of the group's development was in '96, when the foundry business acquired a machining facility, prior to which it was commonplace for the OEMs to purchase raw castings and machine them themselves, or get the casting producer, i.e. the foundry, to source that machining for them. What used to happen was the foundry used to blame the machinist, and the machinist used to blame the foundry, and many problems ensued. So the biggest customer of Castings at the time, which was Scania, insisted that Castings got its own machining facility, and that was added in '96. In 2009 into 2010, at our William Lee site, we built a brand new production facility for making slightly larger castings, and that's still a mainstay of the production at that facility. So where we are, we're highly invested, iron foundry machining group, high-tech stuff. Those of you who've been fortunate to visit before, or if not, it's an amalgam of some pretty interesting traditional processes and some real high-tech automation, computer simulation, and even AI in a number of instances. So strategically, the slide shows where we are. The most important thing to get across is that the business has been successful because it makes small batches of parts, but uses high-tech, high-performance equipment to make small batches of parts. So that was given us a sort of unique selling point, enabled us to invest heavily in our business. We have a very strong balance sheet, and we're also extremely agile when it comes to opportunities, both in terms of customer, potentially in terms of M&A. We have very good relationships with our OEMs, which are primarily the truck sector, which we'll come on to in a bit, and a very good, well-invested workforce, and pleased to say a very good apprenticeship program, which typically fills the roles of senior management as they come towards the end of their time. That's a sort of circle of events where our design collaboration with very good technical people, foundry capability that enables us to produce, say, small batches of parts, but using high-tech equipment and high-volume equipment, which is then machined and actually assembled quite a lot these days in very extremely well invested machine shop and delivered to our customers. So you're going to. Okay, so it's a revenue profile. So you can see we talk about heavy truck, and just as a what do we mean by that? Well, we mean the large articulated trucks, pretty much that you see on the roads. So if 71% of our sector is heavy truck, these are 16 tons and over, engine ranges of 9, 11 and 13 litre. Not really to be confused with the slightly smaller rigid trucks that you see going in and out of cities, which typically have a much smaller powertrain, and that's not really our market. The automotive sector, which used to be bigger, when we say automotive, we mean passenger cars. Not really a focus area for the group. It's still sort of 10-11% of the business and declining. And our other business is typically made up of agriculture, railway, and wind power. In terms of the geographic split, as you can see, exports to Europe is our main sector, but the rest of the world, which is primarily America, has been growing from a fairly low level 2 or 3 years ago, and is actually continuing to grow. It's a shame with the coronavirus we've not been able to make so many visits and so on, because the relationships we have in America typically work better face to face. So there's some of the customers. They're all pretty much blue chip customers. As you see, the truck players in Scania, Daimler, DAF, MAN, and some other slightly smaller customers, but fairly important to us, including material handling, Toyota, and some hydraulic businesses, the likes of Danfoss and Parker. So this shows the how we follow the truck sector. You can see on the top slide that we have from the financial crash in 2008, 2009. Our actual sales. This is specifically from this site, but it's quite a good read across. You can see the business here follows pretty much the European heavy truck registrations, and you'll see the latest Volvo estimate, which is in the public domain. That has since been revised higher, and the 2022 figures, which we've only been privy to, are not published, but we've seen are higher still. So we do see a very, very good demand at the moment. And that's a sort of follow on from the trend, and a bit more specifically over the last couple of years. We did see pretty good demand at the start of the end of 2018, start of 2019, and even prior to the coronavirus pandemic, we saw some drop off. So when we've been saying that we are back to the pre-COVID levels, we hadn't been back to where we would typically be, but the current run rate is actually back to that sort of level. And again, this reinforces that from our quarterly sales. So the very simple picture: one's an engine, one's a chassis. So if we look at what we sell to trucks on the engine part on the right, we see a number of manifolds. They're very typical of the products that we make here. It's a turbocharger bearing, turbocharger housing as well. It's typical of the product. On the left is a chassis where you see two long steel beams, and there's a significant number of brackets that are contained to that, connected to that, which then hold other things, cables and so on and so forth. Those chassis brackets are made in high strength, high integrity cast iron, which is a big market for us. So overall, the sales mix is 35 to 40% powertrain, and the chassis makes up a similar amount, and non-truck 29%. I think these are yours, Steve.
No,
Still one of mine.
Yeah.
Oh, sorry. Yes. Okay. Yeah. So we're not really able to write down on here what the individual customers are, but the largest customer is Scania, and the second one is Volvo, and the third one is Daimler, and the fourth is DAF. So current opportunities with our current customer portfolio, particularly with Scania customer A, where they have developed and are introducing a brand new engine at the moment. Unfortunately, it's been put back a little while, but will still be launched towards the end of this year into next year. And that particular engine replaces the current engine that we supply to, and we have increased penetration on that particular engine, which is good. But not only that engine will then be supplied to MAN, which is also part of the VW group that own Scania. And there's some talk about some of the product going to Navistar, the American division of, well, it's not quite VW owned yet, but it's not far off. So we've got better penetration on the new engine, and the new engine will be high volume, so that's good. The second customer is Volvo. We'll be supplying a system solution to Volvo again on a new engine later this year, where the manifold system is a very novelly sealed unit, which we've been selected to work upon, and that product is in test at the moment, and it's about to go into low volume production later this year, starting early next year. Again, that's quite nicely additive to our current portfolio. The third customer is a customer we targeted a few years ago, which was Daimler, and that's grown extremely well. We particularly win business with their US subsidiary, which is called Detroit Diesel, and there's some very nice projects starting around about now at low levels, which will impact us over the next couple of years again on the positive. The last customer is DAF. No real new news with DAF other than their new engine comes out in 2024, and at this stage we're hopeful to win further work with DAF.
I'll just talk a little bit about the financial results for the last year. In terms of, Adam mentioned previously about the lower truck volumes. So obviously a key customer base of ours is 70% of our revenue, and the corresponding lower sales weight that we sold during that year was about 16% down on the prior year, which fed through to a 17% reduction in revenue at 114.7 million. Mainly the first half with significantly lower volumes, with truck customers closed for some 8 weeks in that start of that first half period, but a much stronger second half, resulting in an overall profit before tax of 4.3 million, excluding exceptional items. And the main exceptional item on there was a site that we had the machine shop used to occupy, that we sold during the year, having consolidated the machine shop into 2 locations. Just highlighted on there the dividend. We do look to have a progressive dividend policy. Try not to cut the dividend and keep paying it despite difficult times, which obviously we've had this year. So overall, we've increased the dividend by 2.5% on the prior year at 15.26. Cash generative during the year, despite COVID, to the tune of 2.7 million, resulting in a year-end cash position of 36.1. We did, as a board, give consideration to a special dividend, but given everything that's gone on and the uncertainty, we felt it was sensible not to pay that at this stage, and look to sort of reset that in the new financial year. In terms of current year, the consensus numbers in the market are a profit before tax of just over 16 million, with cash to rise to 46 million, so up 10 million on the current year-end position. There is a research note that the company's broker, Arden Partners, make available on their website, which you can register for and receive that. Just on the next slide, just breaks it down a little bit more into the segments and between foundry and the machine shop, and also splitting out first half versus second half, obviously particularly important in this current year. So in taking the foundry segment, first half extremely difficult in light of COVID and the OEMs being closed. Sales weight down 43% compared to the prior year on the foundries in that first half. We took the decision to sell from stock to preserve cash, obviously not knowing how the pandemic was going to play out. And pleasing to see that there was a small profit in that period in the foundry segment. Second half in the foundries, much stronger, as I said before. Sales tons are actually up 14% compared to the prior year. But as on one of those earlier slides, you'll have seen that the quarterly sales were slightly depressed this year compared to, or last year, sorry, was slightly lower than the typical levels. Profitability improved to 5.9% at a margin of 7.5%. That margin was still impacted by disruption, with employees having to self-isolate, particularly around the turn of the calendar year, which, as you'll appreciate, in a manufacturing environment is quite tricky to maintain productivity. In addition to that, we did see raw material price increases in the last quarter of the year. Now we have price escalators in place with our customers, which means we do get to pass those through. But unfortunately, there is a time lag of 1 quarter. So the price increases that we saw during that Q4 are passed on to the customer from the 1st of April. So it does have an impact on the margin in that Q4. In terms of machine shop, much of the output of its business is within group. About 85% of it now is within group. So that destocking that I talked about earlier had a particular impact on the machine shop in that first half. It didn't have that opportunity to make those sales within group. And it's a well-invested business with carrying a high depreciation charge of 4.5 million. So difficult for it to operate at such low volumes in that first half. Second half, much improved. Really, month on month, we were seeing better results in the machine shop, and ended the year with 2 months of profits, and that's continued in the current financial year. On this slide, talking a lot about the cash generation, we do generate strong cash inflows. So this slide just sort of sets out the last 30 or so years, showing where that cash has been generated and been spent. So that strong generations enable us to invest in the plant. As you'll see, the blue bars around capacity previously, and then more recently around automation. That automation investment does continue, but the funds required are of a much lower level. So you're looking at between 4 to 5 million of capex probably over the next few years. It's also enabled us to fund the pension deficit, which are the orange bars on that chart. And that in turn enabled us to take the opportunity to move to a buy-in of the scheme in March last year. So that significantly de-risks the balance sheet of the pension risk, and we're work towards buyouts, which will ultimately wind up the schemes during this current financial year. Also, just to highlight strong dividend, as I mentioned, the progressive dividend policy. So we've not cut the dividend, we've always looked to maintain or increase, which is the green line, increasing, and also a couple of special dividends that we've declared in the last 5 years. That's it.
So one of the questions that we are asked about a lot is what is the impact of electrification within the truck sector going to mean for castings? Well, the question at the moment is the issue at the moment surrounds what the technology is likely to be, and it appears to be one of either battery electric or hydrogen fuel cells, and our customers seem to have conflicting views as to where that's going. So the OEM's view, this is all publicly available information. In the case of Scania, by 2025, 10% vehicle sales will be battery electric. That doesn't have a huge impact on castings because these are the smaller end of the scale, which are the sort of rigid trucks you see going in and out of cities delivering building material and so on and so forth. That's not really our market. But by 2030, they're talking about expecting battery electric to have developed sufficiently that it is usable in long distance heavy trucks. And their theory is that provided the truck can be powered for the 4.5 hours that the driver can drive before he has to have his 45-minute rest, and there's enough charging stations, then that technology would work. At the minute, that technology isn't there for heavy trucks. So that's sort of Scania's take on things. Volvo and Daimler have started a joint venture called Cellcentric, which is to develop and look at hydrogen fuels. They're talking about starting hydrogen fuel cells by the middle of the decade, and getting into some serial production by second half of the decade, and their entire fleet to be fossil free by 2040. And Daimler are saying 60% of vehicles will be zero emission by 2030. Of course, a lot of those vehicles are not the vehicles that impact on castings, but nevertheless, between a sort of 5 and 15-year period, we will see some technology substitution coming into our sector. And as we saw from a previous slide, 35 to 40% of what we do is on engines. So that gives us both a sort of threat and opportunity. On the opportunity side, we believe that the strength of castings is such that a lot of our competitors will see consolidation within the competitive market and will win business on the non-powertrain products. At the same time, we are actively looking at potential M&A into other materials that will be more relevant in a future electrified truck market, which we believe to be aluminium. And we engage with a local consultancy looking at where and what products are going to be required for the electrification of trucks in, say, 10 years' time. So, in overall summary, this is a business, very strong business with cash on the balance sheet. There's no debt, and literally there is no debt. There's no leases. The pension soon to be, the group soon to be deleveraged from its pension, which we expect to be completed this financial year. We've got good opportunities, not least with the current business, some new business coming on stream, and the American market is, we believe, is ripe to be to be further exposed, and some potential for M&A if the right targets come along. So thank you for your time.
Great, Adam and Steve, thank you very much for that presentation. Clearly 2020 was a tough year, but encouraging to hear about the sort of second half on first half improvements that have come through, and indeed the month-on-month improvements that you're talking about going into the current year. So that's encouraging. We're now going to take questions from attendees, and if you do like to ask a question, please type it into the Q&A box and we'll try and get through as many as we can. I'll start off with one here that refers to one of the slides you talked about, which was in terms of the electrification. Given the importance of commercial vehicles and automation to the group, could you talk about exposure to the combustion engine and how you'll manage the long-term transition to electric vehicles? And are there enough opportunities to offset this headwind? And what are your main green economy opportunities for the group?
Okay, well, hopefully I covered to a degree that if somebody invented a battery that could run a truck tomorrow, then our exposure is 37% of the group. That's a fairly detailed analysis that we've done. Now, what we do know is that the electrification so far on smaller trucks has actually given us opportunities. In the smaller truck sector, which we don't typically supply, we are now supplying parts which would probably make up maybe 10 to 20% of the 37% that we're going to lose. Now, there are also bracketry which will be associated with electrification, which we don't know what that will be. That will probably make up to half of the 37%. So the overall impact in 10 to 15 years' time is probably somewhere around 15 to 20%. At the same time, we're working with other customers and developing new business in and around braking systems, which are not impacted so much by electrification. We have some business with wind energy. That won't make up much of a shortfall. And of course, as I said in the presentation, a number of our competitors are likely to go out of business or to consolidate, and that will offer opportunities in the current products which are not impacted by electrification. But probably the better positioning will be if we can partner or acquire aluminium technology, where the growth is anticipated to be pretty high in the electrification of trucks. Hopefully that answers the question.
Yeah, great. Thanks, Adam. I've got a question here that came in ahead of time. It's from a long-standing shareholder who has, in his view, seen sort of operating margins and return on capital reducing over the years. And the question he's asking is, what can management suggest, or how can management suggest this is going to change going forward? And how can you give him confidence that he should maintain his position as a shareholder?
Well, he's right. We have seen, we had some difficulties within our machine shop 3 or 4 years ago. That needed to be addressed. Some management changes were required and refocusing. And then we saw a period of downturn around 2019, and then we've seen coronavirus. So we've had 3 or 4 years really impacted by something self-inflicted and other things from the outside. As Steve alluded to, consensus view is of north of 16 million this year. We see ourselves getting back to the sort of levels we were at before. Foundry profitability has been pretty steady and continues to be so. And I'm pleased to say that our machining business is recovering really quite well. At a time when the investments have largely been made. Yes, there's still sort of 4 or 5 million of capex per year, but against a depreciation of 8, we will start to see some of that depreciation coming back out as profit over the next few years, in light of the heavy investments we've made over the previous year. So, we do see that that profitability returning, return on funds returning to where it's traditionally been.
Thank you. The question here, I think, is targeted for Steve. Based on brokers' estimates, it looks like depreciation will exceed capex by approaching 4 million in 2022. Could you argue that prospective operating profits is understated by more than 20% due to the inflated historical depreciation?
I think there certainly is. We're very well invested, capitalized business. The depreciation has been is high, has been high over the last few years. We see that dropping off steadily over the next few years, and then a bigger drop off in sort of 4 years' time, when we see that being much more of a commensurate level then to the activity and the profits.
Okay, thank you. And again, just on the capex, can you give the split between maintenance capex and growth capex?
Yeah, I mean, it's a foundry business. If we're spending 4 to 5, probably 25% of that is on replacement kit for maintenance, as you refer to it, Alex. The rest is going to continue to be on automation and high tech development of robotics and some novel things like that is where we're investing. So 75% on automation and 25% on replacement.
Great, thank you. On the balance sheet, obviously a strong balance sheet is really nice to have, but what are your plans for such a strong balance sheet given the funded pension position?
Obviously, with the level of cash that we have at the moment, in normal times, we would have been probably looking to return some of that cash to our investors. But we did take some furlough money, and although we didn't see it as benefiting the company, more to the employees, we felt it was only right that this year we kept a steady ship, and we'll come back to a more normalised review of the cash next year, i.e., some sort of return of that to the investors. But we are also actually seriously looking at M&A. We have a couple of opportunities that we are pursuing, to which some of that balance sheet may be required. So we don't have a dividend policy per se, but when it gets north of 20 million, there's time to do something with it. I guess the only real policy we've always had is to maintain enough cash on the balance sheet to be able to pay a healthy dividend. But as I say, the levels are such that we'd be into returning some in one form or another, or M&A if we can pull it off.
Okay, thank you. What was the impact of raw material price inflation on profitability in 2020, and what are the current trends in raw material prices?
Well, I think in the second half of the year just gone, it was about £1 million. I think Steve got a better analysis. Around about £1 million of impact of raw materials in the year that's just ended, and that's obviously gets invoiced quarterly in advance, as Steve alluded to. The steel scrap in particular has continued to rise, albeit not at the same rate as it rose last year. So we are behind the ball again at the moment, and that'll be catching up again during the year. I mean, I haven't got a crystal ball to know where it's going. I think for the next few months, I suspect it will continue to rise. There's a shortage of scrap arisings, and the steel market is very buoyant, and that's sucking in all the steel scrap from around from the UK, particularly Turkey, and to a lesser extent China. But I only see it going up in the short term.
Okay.
You know, we will see.
And linked to this, does the climate risk and climate transition impact castings for raw materials or your production processes?
So, Alex, the climate risk, you mean the environmental climate or the climate we're operating in business-wise?
I think the environmental climate, the question is asking about.
I mean, just on the environment, perhaps I'll give a wider view of it. I mean, it's an energy-intensive business. You know, to melt iron requires a lot of kilowatts. But it changes in environmental policy and whatever. I don't see the demand for steel changing. You know, as a result of that, you know, if we need to build things, we need steel. So I think the demand on steel will stay, you know, pretty high. Environmentally, from our point of view, what's important is that you know, we continue to reduce our carbon footprint, not least by the fact that we currently, all of our electrical energy coming to the site is 100% renewable. Gas isn't yet, but that's only about 10% of our energy, and something like 90% of our waste is recycled within the company. So we've come a long way in the last few years in terms of that, but ultimately we are energy intensive. You know, we've now secured renewable sources for our energy, but in terms of the effect on the steel prices, I don't see much change. I think you know, we need steel to build things, and whilst we're building things, then steel demand will remain high.
Okay, thank you. Who are your major competitors?
Well, pretty much all in Europe. What was George Fisher, which is now been bought out of George Fisher, a company called Fondium, it's a competitor of ours. There's a competitor in Denmark called Valburn, who compete quite a lot with us with Volvo. Us and Valburn are the main Volvo suppliers. There's a couple of Spanish foundries, particularly on the sort of slightly lower tech end, and a French foundry called La Fonte Ardennaise is also a competitor of ours. The Turkish foundry industry is very good engineers, but they typically operate at the high volume end. So we kind of come up against the Turkish outfits if we are quoting higher volume parts, which don't make up a massive part of our business, but we do come across the Turkish industry at the high volume end.
Okay, and looks like we've got a couple of questions in on this, a link to that question. How do you consider the company's competitive position relative to your competition?
I think I can't overplay the importance of our focus on relatively small batches of parts in a high volume environment, in using equipment that is akin to a high volume environment. So we have all sorts of novel things that we do to maintain this ability to supply, you know, lots of parts. I think I have some data. I mean, we typically sell 2,500 part numbers in a year, and you know, 250 part numbers generate over £100,000 each. So there's a lot of part numbers being managed in the business. We are unlike most of our competitors in that regard, and that's what gives us a competitive edge. I think Steve's trying to find a slide. Yeah, that gives you a bit of an idea of the spread of part numbers and so on in the appendix. So the likes of Fondium, for instance, they typically make much higher volume parts than we make, and we probably would struggle to compete on the high volume end, where they've got smaller batches of parts, a few thousand here, a few thousand there. Not only can we compete, we can charge a reasonable price in the market, and the competition is not so fierce.
Okay, and this is an interesting question linked to that. What is the optimum inventory holding given supply issues, and what impact may this have on cash levels?
Good question. To manage this, we have to hold what would appear to be quite high levels of inventory. We typically have what do we have here at the moment? 2,000 tons of stock, where we're producing about 600 tons a week. So 3 to 4 weeks of stock, of finished stock, is what we're carrying. And that's across a plethora of part numbers. So our logistics system is a very, very robust system. But against other suppliers into the, say, automotive sector on just-in-time basis, that is a high level of stock. But we need that to be able to service our customers.
Okay, thank you. I think we've got time for a couple more questions, so we'll try to get through a couple more. Why are there not more opportunities in railway trains and carriages?
Simple reason: most of the castings use on steel on the railway and railway carriages, they are steel castings, not iron. So it's not a market that we supply. It's as simple as that, really.
Okay, and this final question that we've got in here: is castings a customer specific type production, i.e. only producing according to customer demand, or producing certain volumes on a serial production basis?
Not quite sure of that. Can you give me that one again, Alex?
Yeah. Is castings a customer specific type production, i.e. only producing according to customer demand, or producing certain volumes on a serial production basis?
No, prefer very much the first. Very much the first.
Okay, brilliant. Well, we're coming to the end of the time we've got available. We've also come to the end of the questions that we've had come in, so that is that's the timing is perfect there. I'd like to thank you everyone for attending and asking questions. Thank you to Steve and to Adam for so comprehensively going through that presentation. And, as I said, encouraging to hear the progress you've made over the last year, and particularly coming into 21-22. I'd just like to flag up a couple of webinars we've got coming up in future. Belvoir Group on the 13th of July, British Land on the 19th of July, and Crossword Cybersecurity on the 20th of July. And then just as you leave today's webinar, you will come across a survey. It would be great to get your input into that so we can give some feedback to company management. I know that they always do appreciate it. So if you could spend a couple of moments just completing that survey as you exit, that would be appreciated. And I'd just like to say, thank you very much for attending, and we hope to see you all soon. Thank you.